All right. Good morning, Larry. We'll go ahead and start. Christian Catron here on location at the Otis in downtown Austin for my birthday weekend. And so very excited to have everybody join us and join me remotely as I'm celebrating. But wanted to welcome Larry on. I'll introduce him here in a moment, but wanted to begin by sharing my screen. um, and then getting started with just an intro of who we are. So Redeem Investments, our tagline is renovating properties, transforming lives. We actually, let me fully share this. We have a couple of segments to our business. The first is on the left-hand side, commercial real estate. That's really the segment of the business where we focus on acquisitions of apartment buildings. Concierge services is a really neat way for us to add ancillary services for our residents in these apartment buildings, things that they otherwise would have to source on their own, except by partnering with us and utilizing our services, they get a discounted rate. So we're talking about things like energy, so utilities, telecom services with phone and internet and cable and some of those things. The next thing is the Redeem Team Mastermind, which this forum that we're doing, this MAGS session, monthly accountability group session, is a part of. It's just one component by which we provide knowledge and resources for our mastermind members to continue to learn and grow and thrive as we pursue acquisitions of large apartment buildings and other types of investments. And then lastly, Redeem Realty Solutions. That's really how we got our start in real estate. And on occasion, we might do a single family investment. But for the most part, our focus is concentrated on the commercial real estate side, in which we are in the process of launching an investment fund, other investment funds within other alternative investment types will be forthcoming as well. To get started, just a quick disclaimer. I'm not an attorney. I'm not an accountant. I'm not a licensed real estate broker or agent, and I'm certainly not a licensed investment advisor. All the information that we're providing is simply intended for educational purposes and really just our way of sharing information that we've acquired along our journey and wanting to make it available to others who would be interested in learning those things. As far as what is a mastermind, so the mastermind structure that we have effectively is a joint venture partnership program wherein I'm making available opportunities for mastermind members to serve as fellow JV partners or co-general partners with various types of investments that we have. It really is ideal for those who are aspiring to become a general partner. It provides access to resources, training, meetings, and events, as I mentioned. There is a limit on the number of members that we have, and so there is room, but it is kept to a smaller size deliberately. As far as who our members are, we have 6 West Point grads, 1 Naval Academy grad. Some of these guys are apartment syndicators, doing stuff in single family, other types of real estate investors. One is a blockchain expert and a nonprofit leader. And so we have a wide array and some pretty good diversity around the types of members that we have. And then I often get asked, well, how can I participate? First of all, in order to learn more, I would say go to our website, invest with us. For those who are interested in investing as a limited partner, you can send an email to that email address there, invest@redeeminvestments.com. And certainly, if you're interested in joining the mastermind, you can go to the website and click on the section that says mastermind to learn more about that. Again, it's a JV partnership program. It is not for everyone. Again, for those who are aspiring to learn how to do the things that we're doing in terms of syndication and investment funds and pooling resources together to acquire deals, those are the types of candidates for the program that we would want. There is room for limited partner investment opportunities in the deals that we have that are upcoming, both within syndications as well as with funds and private money lenders, et cetera. And again, it's limited to 50 members. As far as some upcoming events for us, obviously today we have who I would call it our tax strategist extraordinaire, Larry Dixon, who will be talking to us about strategic ways to utilize taxes as a defensive strategy in order to score points. if you will. Keeping in mind that we're in the middle of March and typically March Madness with college basketball and other things, or you might think March Madness, there is an ongoing type of madness depending on what you're thinking about or talking about. And here we are in the middle of March. So um, we our next meetup is actually scheduled for the 25th of March, which is a Thursday. So in the evening, we'll do a virtual game night. Typically, these are live events that we host, but given the continuation of the pandemic, we've decided to a virtual version of that this time, and that will be a fun event. And then we have in April, our next MAG session, a gentleman named Roel Patterson, who will come on to talk about those concierge services that I described earlier and how that's benefiting our apartments and our tenants, and just really just an overview of what that program looks like for anybody who might be interested in learning about that. And then a really cool thing that we do is have a retreat for our mastermind members. And so we have, I believe, half of our mastermind almost, along with their significant other, joining us in Cancun during the week of July 8th through the 13th. And that will be a fun event filled with learning and um, networking and planning and strategizing, as some would say. So I'm excited about that coming up. Okay, with that, let me go ahead and transition to Mr. Larry Dixon. Let me stop sharing my screen, and then I will turn it over to you, Larry, here in 1 second. You don't see my screen anymore, do you, Larry? Oh, I can't hear you.
I still do see your screen.
Okay, you still see my screen. Me? Hmm. All right, well, let me hand it over to you, make you the presenter, which hopefully will then allow you to share your screen.
Absolutely, and I can from this right here, and so I can pull up my screen, and then once we start there, perfect. You guys should be able to see my screen now.
Yep, I can see it.
So everybody, as Christian said earlier, I am tax strategist. I've been working with him, his companies, and I started my own business. And my niche would be in real estate. So the best way that I've always thought about taxes is I used to want to be in stocks, and I heard a stock guy say like, "Hey, we're the offense, and you want a good tax guy so you can play defense." And so whenever I kind of fell into my love of taxes, I've always been like, well, I don't want to be passive on defense. I don't want to be reactive. So I've always thought of defense as being as proactive as possible through planning. And we take in there's defense and we help that defense make you money at the end of the year. So that's how I think about taxes. So I am described as an aggressive person, and not with kind of the fungibility of the law, but more in my proactiveness of helping you reduce your tax liability at the end of the year. Because again, I think that's what everybody cares about. So that's what we're going to be doing here today. We're going to go over an overview of how your tax situation looks like, how you would identify yourself as a real estate tax person, and then kind of the tiers to tax strategies and how you should be thinking about your business from the tax view. So again, next slide. Again, it's our duty as American citizens to pay taxes, but in my mind, we should never pay a penny more than we have to. So everything that we do here at my firm, we want to reduce your tax liability in the absolute most, right? And we have different strategies that we implement, but we also try to take your life and take the things that you're already doing and have that be a tax deduction there. And we'll talk about that later. And so the easiest way to think about tax deductions is an incentive, right? So the government's going to put a tax law into practice. They are trying to incentivize the American people to go into that sector of business. And the easiest one to talk about, and the reason we're all here today, is real estate. Real estate is the most incentivized sectors in all of our tax code. And so real estate right now is kind of where the mecca of investing is, right? And there's 4 key components that I like to talk about whenever I talk about real estate, right? Because it's my 4 big reasons why you should be in real estate. The first one is appreciation here. So you see at the top, we've seen just at least a 2% rise in just the value of a houses over time. And obviously different areas appreciate different rates, but appreciation in real estate's a big thing. Your actual principal pay down, right? So every time you make a payment on that asset, you're getting more equity in that asset, right? And that does two things for you, really. You can either sell it and take money, or you can use that to leverage that into other deals, right? The third one is cash flow, right? So those are just, we make money every single month off our real estate, and that's nice, right? Some dividends that they pay out in the stock market, and your portfolio investments only come out quarterly, if that. And so to have a monthly cash flow from something that you can feel and touch and see is amazing. And the fourth reason is why I'm here, tax deductions. Again, this is in that quandary zone of something that you can have an investment in that also provides you tax incentives at the end of the year that will help you reduce your tax rate. And so the first thing that I like to do is lay out your game plan, right? So there's two sides to every real estate person, right? There's an operational side, and this is your wholesaler. This is your property manager. This is your real estate agent, right? They are they're operators in the real estate sector. And then there's the passive side of the investment, right? And this is what we all know. This is just if you go buy a house, if you go buy a multifamily home, a complex, a business sector, it's just an asset that's sitting there. But both are going to be taxed differently. And so we have to understand that we should categorize everything. And so the simplest way that I've been able to lay it out, or that I've seen laid out, is what I call, or what has been called, the trifecta, and I've really latched onto it. So it's broken up into two sides. So you have your operational side, and then you have your passive side. And before we go on, notice that the portfolio side, the stocks, is not on here, and we can talk about that later, but I really wanted to focus on providing you guys the most value. So the operational side, that's where you're going to see that 15.3% FICA. This is your your Social Security and your Medicare, right? That 15.3%, which if you're going out on business on your own, that's the self-employment tax that we all know and love. And on the passive side, you don't have any of that self-employment tax, right? So that's the big differentiator for choosing and classifying yourself to either side. And the only place that this super gets fuzzy is in the Airbnb space, because there's some nuances there that can push you from left to right here. And the arrows are important to know, because I think everyone should have a trust. Now, I'm not a trust lawyer, but I think just as a great overarching statement is everyone should be developing a trust, especially if we're going to grow our business, and especially if we're going to grow our passive asset portfolio or a portfolio of investments in real estate. You should definitely look at a trust. You should get with a trust lawyer. And it's very important, just as you pass, as we all, the inevitability of taxes and death, we go, the trust is going to help you offset a lot of those probate problems in the future. So this is how I think everyone should think about their life right now. And so the most important thing right now is just identifying yourself, right? Like, who are you as a real estate person, right? And everyone simply goes to, okay, well, I'm only doing commercial real estate. I'm only doing multifamily homes. I'm only doing syndications. And I think that's amazing that you guys think that way. But I think the way the tax book tells us to think, right? So there's three main categories of real estate, right? You have the passive investor, which is the lower rear tongue. And think of this as REITs. Think of this as syndications. And the easiest way to describe this is you're not making any decisions in accordance with the property you control, right? So the big one that we see is Grant Cardone and the Cardone Capital Fund, right? And I think he has like 7. I don't know. I don't mess with him, but I know he's the easiest one, right? You give him your money, and he says he'll give you the cash flow, and then when he disposes of the property, then he'll cut you a check, right? Easiest way, you make no decisions, you give him the money, you sit back and you let those checks roll. This is a passive investor. Active investor, this is just everybody else, right? Or almost everybody else. Well, if you buy a property and you're making the decisions, right? So I'm calling the person who's going to come fix the plumbing. I'm calling the guy who's going to fix the roof. I'm the one interviewing the people that are coming in, right? And the important thing here is if you have a property manager, it doesn't push you into passive. It keeps you in the active realm, because you're still making the decisions, the ultimate decision maker around your property manager, right? And so that active investor space is where most people sit. But I think everyone should at least work to get there in some capacities in your investments. And the mecca of it all is the real estate professional, right? And this one is very, very particular, right? So it has to be your primary occupation. And what that means is if you have a W-2, so you work a W-2 job and then you invest in real estate, you can't qualify here, right? It's literally just a blatant, because they say that you can't have enough time to put on 750 good hours. Now, we all know in real estate, we absolutely can put in 750 hours, which only amounts to like 14 hours a week. So could you put in 2 hours a day on real estate? We all could, between education, looking at properties, talking to people who are going to fix our properties, walking the properties. That's too easy. Plus, when you count weekends, right? And then once you hit that 750 hours, it's the 7 tests for material participation, right? And we won't dig too deeply into those, but obviously we can. You guys have questions at the end. But those are the big 3 things to outline, right? And so the question becomes like, well, what does it mean if I'm in any one of these categories? And so for the passive, you have passive losses that generally come from real estate, right? Due to depreciation and things of that nature. Those passive losses can only offset other passive income, right? And so that's other real estate investments, that's other investments in companies, things like that. That's not portfolio income, that's not your stocks, that's passive investment. Active investors, well, when they take losses, $25,000 of those passive losses can offset that active income, right? And the phase out happens between $100,000 and $150,000 in your total income. So obviously we can see as we make more money in our day-to-day jobs, we lose that kind of net of that passive losses that really makes real estate a great investment. And so the question becomes like, okay, well, I'm making over 150. What's next? And that's why we say real estate professionals are the mecca, because they have uncapped passive losses that offset their active income. And so the coolest story that I probably heard is Grant Cardone, where he bought his jet and then he wrote off that $30-50 million purchase in 1 year, and that offset everything. Well, because he's a real estate professional, right? Like he has the ability to do that through his real estate empire, right? And that's when it becomes good. And that's when you start to see people do different kind of cost segregations, which we'll get in later. And they'll take massive amount of depreciation losses and offset their income down to 0. So that's when you can really be creative in how you're going about your process. So now we're going to get into just really like how I think you should build your business in real estate, either as an investor or as a practitioner, right? And these are the things that everyone should do. We're going to start at the basic things that everyone should do, and then we're going to go to some high-hanging fruit, which as you become a high-level operator are going to be very, very beneficial to you, right? So the first thing everyone needs is they need great books and they need great record keeping, right? And whenever I say books, that's your accounting, right? So if I ask you to pull your profit and loss statement, you should be able to pull your profit and loss statement, whether you keep it on Excel, QuickBooks, Folio, Cozy. You want to keep great books. And this matters because as you start to have your property become a business, or your investments become a business, or your operation become a business, we have to be able to analyze the health of a company, right? Then we can start looking at, well, how many repair costs are you putting on this specific property? How is your advertising to fill in your multifamily home affecting your business? Is that advertising helping, or is it just a place you're losing money? Record keeping, receipts. I can't tell you how many times, how many horror stories you hear where people get audited, and not even for doing anything wrong. The IRS does random audits. So they'll show up and they'll be like, produce X, Y, Z receipt. And if you can't, they have the potential to throw out that entire purchase. And where you see it the most is places like Walmart, Target, Costco, Sam's Club, because you can buy anything there. So if you went and bought a computer from Walmart with no receipt, they can say like, how do I know that that's not beer? How do I know that's not groceries? And you know, and they may even know, but if you can't prove it, you lose the power. That record keeping process is everything. Your leases, your obviously receipts, because I'm going to talk about receipts. I'll say it a million times, receipts. And then your different itineraries, building up your plans for your trips, all those kinds of things, those records matter. And then keeping those on file and making them easily accessible. And the last thing, keep those 2 things clean, right? Whenever you're messy, right, you bring messy things to your lawyer, you bring it to your accountant, you bring it to the person, someone, a business coach. When they see you're messy, 2 things happen. They don't take you nearly as seriously, because it's hard to take you seriously when you're messy. And 2, there's going to be a propensity to charge more because they feel they're going to have to do more work. And especially with lawyers, I think we've all talked to a lawyer before, they love to charge by the hour, and they make sure they get all those funds, right? So the next thing is going to be the basic deductions, right? So this is the base lower deductions everyone should be looking at every single day. You should start seeing it everywhere in your life, right? And so I can't tell you how many times I open someone's tax return and I go to their Schedule E or their Schedule C, which is their profit and loss for their business, profit and loss for the real estate, and they're not capturing all those things, right? Simple things like they're not taking their insurance and deducting it against your rental property. Like, why wouldn't you do that? That's the reason you have that umbrella insurance, right? The repair costs, they don't have all the receipts, And what happens is people start making guesses, right? They're like, oh, well, I did about $2,000. And because no one wants to get in trouble with the IRS, they always underguess, right? So if you tell me it's $2,000 and it's actually $2,513, well, you just lost $513 in deductions, right? And if you're at the marginal tax rate of 22%, which is about average for a real estate investor, then I know in my mind, you lost about 125 real dollars back into your pocket. And everyone's like, well, that's not crazy, but I bet you if I gave you $125, you'd be like, no, I'm going to take it, right? The last thing I'll say on this slide is, well, second last thing is self-improvement, education, these masterminds. Anytime you do something that you feel is going to grow your business or your ability as an investor, that is a tax write-off. The books, obviously we covered the masterminds. The anytime you go to a webinar, a seminar, we have to start capturing it and understand that this is our form of continuing educations. So be really scrutinize those, right? So like, are you buying a fiction book or are you buying a book on real estate, right? Are you on Bigger Pockets? Obviously you're in this mastermind, you're going to the retreat. All those things we have to start capturing because you don't just own an investment property, you started a business. So when I say be a business, it's because people aren't treating them the same. And the last thing is depreciation schedules. I've seen so many of them be messy, be wrong, not taken enough. Take the time, either know it and be right, or take the time to consult with a professional. Even if you're just wanted to be like, hey, I just need that one-time consultation to make sure that my depreciation schedules are right. Because that's money. That's why real estate's so amazing, because that depreciation, that paper write-off, which isn't directly affecting our business in that year, but it's lowering our tax liability, it's massive. So again, these are the basic low-hanging fruit, things that everyone should look at in every single day. And so understanding this, we can start to build on this, right? So I come in, I open up their Schedule Cs or Schedule Es, and I'm looking for these basic things, right? When someone's checking these off the block, I know that they're ready to start planning. If you don't have these basic low-hanging fruit, you're not ready to start planning and doing bigger level strategies, right? And so these are more next level strategies. Not that they're going to blow your mind, but this is when we really start to take your life and push it through your business or your Schedule E grinder in order to reduce the tax liability. So the first one, most people have kids, right? Most people give your kids an allowance of some sort, right? Most kids pay for their kids' soccer camp, and they'll be doing that. And then they'll have kids working in the business, whether they're coming out to the property to mow the lawn, whether they're fixing up the home office, whether they're doing expense reports. I've heard all crazy things that people do, because whenever you run a business for yourself, you're always pulling help whenever you can, because free labor is amazing, especially when it's efficient. And especially as kids, you can tell them to do everything. And so I watch this, they're paying the kids allowance, the kids working in the business, and they're not taking in the deduction, right? So you can pay your kids, right? And it's really a way of shifting your income. And when the kid's under 17 years old, a crazy things happens when you shift that income, right? So in this scenario, we're going to pay each kid $3,000. Sounds like a lot of money, but that's $250 in allowance a month, right? And it doesn't just have to be allowance. Did you pay for them to play little league sports, right? Like when I played baseball, my mom had to pay $180 for me to sign up, right? Did she pay for that, or did she pay me in her company, right? And so $250 a month is $3,000 a year. Between those three kids, you have a $9,000 deduction, right? We talked about it earlier. The average marginal tax rate for an investment property owner is 22%. Well, you just saved yourself $1,980 in real cash savings just by paying your kids an allowance, just by paying for the things that they're already going to be doing, right? We've all seen the AAU travel for soccer, for basketball, for baseball, for so many sports. You're paying for the travel. They're working your business, and you're not writing it off through the business, right? Now, the crazy thing, the second thing I asked, well, won't the kids have to pay tax anyways? Won't the kids have to pay payroll taxes? And the answer is no. So when kids under 17 years old, they don't pay payroll taxes if you, the family member, are paying them, right? Or you, the parent, is paying your kids, right? So the payroll taxes is zero. The pay that you pay them is less than the standard deduction. So the only thing that you may have to pay for is state taxes based off of where you are. I'll never live in a state with state income tax, but if you do, then we have to look at the specific state income laws, right? But if you live in, say, Florida, Texas, Wyoming, Alaska, South Dakota, New Hampshire, you're not paying any state taxes. So your kid's paying $0 on that $3,000 you're paying. You're taking that $9,000 deduction, and you just save yourself $1,980. And again,
Oh, hey, real quick, Larry, I think this was a great one. How does this look as far as, do the kids have to be W-2 employees of the business? How does that work from that standpoint?
and so this is where, again, it depends on how you look, right? The W-2 requirement, some people, have you do it because they're not paying any payroll taxes. Because they're your kids, there's less requirement for a W-2. So some people don't submit them. I submit W-2s. So I submit W-2s on behalf of the kids, and then we put that on the IRS and we zero it out. And then if anyone comes to and like asks, you basically have on file that's your kid. You should have all your kids' basic information anyways. And it's a completely clean slate there. What that also allows them to do, because they're getting a W-2, is you can start their IRA investments, and then you can start investing in IRAs at a very, very young age, and we can build that out. But the requirement is a W-2 just to be safe. And then in the categories, I think it's 3, 4, 5, 6, you would just zero out those categories because there's no payroll tax liability there.
All right. We got to talk about that one.
No,
On
absolutely.
a side note, I love that idea.
And then that perfect. And that's the best example. And so, and when you have real estate, the question is, how do you pay them, right? And so you'll have your real estate investment, as you see here at the top. You'll pay what's called a family management company, right? This is going to be your family hub, right? I like family management companies because as we invest in multiple properties, as we invest in multiple classes of properties, as we invested multiple sectors of multiple classes, right? It gets confusing. Like, where do I take the simple write-offs? Like, where do I take my printer deduction? Because I bought a printer so that I could print all my expense reports so I could keep my record. Where do I take the expense for my computer? Because I need a computer to manage my real estate empire. Well, the family management company is the way to centralize this. So then all your properties will pay a fee to your family management company. And then your family management company is your centralized hub to do all those base deductions that we talked about earlier and where you pay your kids up, right? And so that's how I've always structured it. The family management company is just a sole proprietorship. So the EIN is free. And then once you have the EIN, you just set up the account with any bank, right? If you don't know what bank to go to, I'm not paid by them, but Navy Federal Credit Union, other credit unions are really good at this. And then Chase is also a pretty good bank for this. Not paid for them. It's not an advertisement. I have no affiliation with those banks. Well, besides, I have those banks, right? So that's one of my favorite strategies, right? Simple, low hanging fruit, next level strategy. Not everybody's talking about. The second one's game planning, right? And I go into convulsions. We have properties all around the country, right? We all have different parts of the country that we like to go to, but we don't live there. We don't live next to it. So sometimes we have to take a trip out to go see our property. Like, I'm taking a trip on a 4-day to go to Florida to see one of my properties, right? Because I like to put eyes on it at least once a quarter. And so people travel and they don't understand how to understand how to travel. And the best way to do it is called wrapping your weekend, right? The IRS has stated that if you work on a Friday and you work on that Monday, well, then your Saturday, Sunday, although you don't work, still counts as business work days, right? Because you're stuck to wait till Monday to work. So now, when I fly in on Friday and I walk my property, talk to the property manager, talk to probably a contractor on Friday, and then Saturday, Sunday, we go to Disney World. And then Monday, we go talk to the property manager again, one final walkthrough and a couple more contractors. That whole weekend is tax deductible. Now, the entertainment's not tax deductible. So Disney World would not be tax deductible, but my hotel stay for that 4-day weekend, so 3 nights, would be tax deductible. The flight down there would be tax deductible. And the meals are tax deductible. And that's important, especially because meals right now are 100% deductible. Because prior to one of the CARES Act, or the latest, or well, now, the second stimulus package passing, meals, three martini dinner, as it's named, are go from 50% deductible to 100% deductible. So now that's creating another gap. So now in this 4-day weekend that I have it set out, I have a $500 flight, 3-night hotel stay is going to be $375, and $200 in meals. Well, that's going to give me $175 of deduction. Again, we talked about that average marginal tax rate. I'm saving $237. And the real power of this is because, again, you're like, well, I spent 1,000 to save 237. Like, that doesn't make sense. Like, how am I saving money? But the power of this is that your life now is becoming tax deductible. Because did you go see your property, or did you take your family to Disney World? And so you're like, well, now I can strategically place myself when I want to do other things, right? And that's why you see people that love Texas and then they go to Dallas and they go to Austin and they go to these places and they love Las Vegas and then they love Fort. And then you can bring in your entertainment with working, right? And so you can capture things that are already going to happen and make them tax deductible events. And I think that can help you power first your family to get more buy-in to the business, right? You can teach them during the travel so you can split up the fun and the work. And then again, you can just continue to get back. And this works with all kinds of strategies. So as you go to a mastermind event, if you had a retreat that you were possibly going on, you can strategically plan this same kind of method in order to make that entire trip tax deductible, right? And this becomes super important with every single person here that has any kind of entity, an LLC, an S corp, a C corp, should be doing some kind of yearly meetings. Well, your yearly meetings don't have to happen at your house at your table. Like, where are you taking those yearly meetings? And so this is how you start seeing companies take those week-long retreats and making them tax deductible for the company, right? So again, I really, at this level of tax planning, want to change your way of thinking. That everything you're doing, the first question should be, how can I do this with my business? Because there's tax incentives surrounding your rental property or your real estate business. So we always want to use what's already given to us in the tax code. The next one, and this is my favorite strategy, right? So this one, they're making very specific to S corps or C corporations, right? So right now I'm talking to my practitioners, my operators in real estate. And you see this a lot with wholesalers, you see this a lot with real estate agents and management companies, right? You go from the LLC and then you go to S corp status. Well, once you go to S corporation status or C corporation status, we'll talk about C corporations, but once you go to those statuses of corporations, you can rent your home to you and then take the deduction for the rent. So how this works is, say that you're going to have your monthly meeting at home, right? So I know for a fact I do a monthly meeting. I meet with mentors, I meet with people who are going to build a business, and I usually meet with all kinds of vendors that I either want to do automation or I want to bring in new pieces of hardware. I get a lot of demos that day, right? So it's a big dev day for my business. Well, I'm working in my house, and if I were to rent a space to have these kinds of meetings, right, at a hotel, for example, for 50 people, I would have to pay to have that space. And if I wanted to use that space with a projector, with internet and food, that's probably like $800 easy. And it's different based off of where you are, but I know where I'm at specifically, it's $800. And if I do one meeting a month, well, then that's a $9,600 write off, 800 times 12, $9,600 write off against my business, right? And my business paid me $800. And so the first thing that should come up, like, Larry, you received rent. Shouldn't you pay taxes on that, right? Well, if you look there at the bottom, IRS code 280A says if you rent your home for less than 14 days, all those rents aren't claimed on your taxes. And so now I'm leveraging my home that I own, obviously. I'm taking a $800 deduction for each of those 12 trips, $9,600. The marginal tax rate for investment property owners is 22%, again, on average. And so I just saved myself $2,112 in taxes, real tax savings, where I'm not spending the money, I'm transferring it accounts. So I'm pulling it out of my business, saving $2,112 in taxes, and then not having to pay any taxes on that $9,600. So again, this is another shifting income strategy where no money's coming out of your pocket, but we're saving you money. And so what you're going to see in these three strategies that we went through, I saved you I didn't save you, but potentially you could save $1,980 plus the $2,112. So that's going to be roughly $4,000 plus the $237. And I'm not asking you to change your life. I'm not asking you to change your business. I'm asking you to think again, how can I leverage my business to reduce my tax liability, right? We're building in wins with the tax code to put more money in your pockets, right? And this is what I mean when I say, hey, we want to play defense, but we want to have our defense score some points, right? Taxes will never be the thing that makes you money, but if we can turn that defensive side to put more money in your pocket, again, we're going to continue to heal and aid in the business. Because if I told you right now, I could put $4,300 in your pocket, you'd be like, okay, well, I'm willing to listen.
Yeah, I think that's a good point, Larry. Oftentimes when I'm asked to talk about the topic of wealth building, although myself I'm still on that journey, is really three layers. The base layer is how to make money. The second layer is how to keep that money, and then the third, sort of the top of the pyramid, is how do you then multiply that money. And so this is really that mid section that you're talking about in terms of strategies, in terms of keeping and retaining that money with regards to taxes. I like that.
100%. And that's kind of just what I try to get people to do. I try to increase their funnel, make more money, right? That's the easiest one. I want to reduce your cost. So if I'm looking at your business, I'm always looking at like, is every dollar efficiently being used? And then once we get that net income, I'm like, okay, how do we reduce your taxes to keep more money in your pocket? And then once we have a great system, we just, again, like Christians, we're just going to multiply, right? And that's what we do. And then we're going to repeat, turnover, and then make it bigger, right? And I think, again, these three strategies are just low hanging fruit, and not all of them will work. But again, I always want you to think proactively with in the tax realm with your business. And so now we're going to get into these are the top tier strategies in real estate, right?
All
And when
right.
I
So
say,
these are
sorry,
the 3 pointers now.
yeah, these are the 3 pointers. These are
Okay.
the big gainers, right? And these two are the things that constantly get used, and they're used at a high level and can really reduce. So the first one is cost segregation, and this one you kind of hear as it's just thrown all the way around. And if you're a real estate professional, this should be your bread and butter as you acquire a new property. And so what you're going to do is you're going to acquire property, right? And then you're going to do some form of cost segregation study. I personally recommend everyone always get with a professional company because when the engineers break everything down, they really dummy proof it. They dummy proof it for you, so you really feel like you understand it. You're going to walk out there and be like, no, I already knew all this, so this is good. And then it's also going to dummy proof it for when you take it to your tax professional, right? I like to have them work in conjunction, but at the very least, that report they give you is going to dummy proof it. They're going to say, no, this is 5 years, or this is appliances, this was furniture, this is the structure, and then they're just the tax professional is going to know how to depreciate that, right? So what they're doing in this process is when you buy a home, right? We'll say you buy a 4 quadruplex for $500,000, right? Although you buy it for $500,000, you have to depreciate over 27 and a half years. So you can't expense any of that in that year. No matter what, you have to put it on the depreciation schedule. And when you do your walkthrough, it's yours, and you're gonna look around and you're like, well, that's weird. Like, well, these cabinets, oh, that's not a house. And you're gonna be like, well, this door, that's not a house. And so what the cost segregation does is it breaks down your house into individual components, right? Because although your house came with a fridge shouldn't be depreciated over or 27 and a half years, right? The door shouldn't, the cabinets shouldn't, your garage or your roof shouldn't, your driveway shouldn't, right? And so they'll break it down into these 3 categories, and there's a couple more, but these are the big ones, right? So they break it into the 5-year depreciation schedule, appliances, carpeting, and furniture, your furniture and bigger furniture and more equipment, right? And then your structural improvements thing, your driveway, your AC system, your irrigation system, all your water piping system. And then you get it and you're like, well, these can all be depreciated faster, right? And so now instead of depreciating the cost of that over 27 and a half years, you can depreciate that over 5 years, right? So we've accelerated the rate at which the deduction appears on your tax return, right? So now we've increased the amount of deductions you can take in any given year by taking it from 27 and a half years to 5, 27 and a half to 7, 27 and a half to 15 years. And then the final component of this is bonus depreciating all of this. So what bonus depreciation says, it came out in the Tax Jobs and Cuts Act. Jobs and oh my God, Tax Jobs and Cuts Act. I'm sorry, the TJC. Anyway, Tax Cuts and Jobs Act. There you go.
Mhm.
It allows you to take all that depreciation in the year in the first year. So when you buy that property for $500,000, that's a real estate professional. You do the cost segregation. You may have $100,000 in appliances, $50,000 in furniture, and $50,000 in structural improvement. So what we do is we look at it and be like, hey, like I really don't want to pay any taxes here. So what we'll do is we'll bonus depreciate as much as we can, and so you'll end up taking like $100,000 to $200,000 in write-offs in that year. Well, as a real estate professional, again, I said as a real estate professional, this is your bread and butter. You can have an unlimited amount of passive income losses offset your active income. So although you made 120K selling houses this year as a real estate agent, you can write off all of that through this cost segregation that we just talked about. And that's where the power of the cost segregation comes in. And again, we strategize around it, right? You may not want to, it may not make sense, right? You may need that income to qualify for more loans in the future. But there's going to come a time where you're like, well, I don't think I'm going to be doing anything next year, or I can qualify through collateralizing some of other asset I have. You're like, well, hey, maybe I don't worry about it. And so I want to take the entire write-off. And again, at this point, we've changed from being reactive, from taking what's happening to us, to being proactive, right? Now we're thinking out. Now we're taking the tax conversation from what happened last year in 2020 to what do we think is going to happen in 2022, 2027, 2030. And we're being super proactive. And then we can start layering on. And as Christian said earlier, again, we build our system and we multiply it. You can't multiply anything retroactively. It can only be multiplied thinking in the future, right? And that's fair. And so this is another one of the strategies, not to be like, hey, I'm going to use this year, but every time you make a move, we have to be thinking like, what can we use this for? And so again, one of my favorite strategies. The next one I call kicking the can. You guys probably know it as a 1031 exchange. And so 1031 exchanges, hey, I have this rental property. I want to get rid of it. It no longer serves me. And I don't want to pay any taxes on it. And so I'm usually like, okay, well, what do you want to do next? And you're like, hey, I would just want to move out of this state. Like I'm in California, don't want to be here anymore. I'd love to be in Florida. So, but I'm going to buy a bunch of real estate in Florida. So in my mind, I'm just like, well, so you don't want the money. They're like, no, we just want to get out of California. So that triggers what's called a 1031 exchange, right? And this is a deferred tax strategy, right? So this doesn't reduce your tax liability. It defers or pushes down in the future, kicks the can on when you'll pay those taxes. So what we do is we take your asset and we sell it, and then we're just going to buy one again, right? We're just going to buy the next process, right? And by selling yours property, keeping the money with the intermediary, again, this is where I have to say, it's a good idea to consult a professional. Can you do this alone? 100%. This can be executed. There's so many minor things that you can get dinged on that erases the 1031 and that makes your tax liability come to the present, that it's just worth it to pay the X amount of money to work with a professional on this, work with a company on this that does this a lot, and do it right. But then by selling your property, leaving the money with the trust company, the intermediary, and then going to buy another property, again, working that same intermediary, you don't pay any taxes on those gains, on that depreciation capture, because you didn't get any money. You're just switching your assets, right? And where this becomes powerful is when you go from a lot to a little or a little to a lot. Let me explain. Going a lot to a little is right now, if I wanted to go buy $100,000 multifamily unit, I would struggle. I would have to raise a ton of money and I would have to establish credibility. I don't have a ton of cash on hand. I don't have a ton of assets on hand, right? And so it would be tougher for me. But I can buy single family homes. So I can stack those little wins. Well, once you get 3, 6, 12, 15 properties, right? You're like, okay, well, I don't want to manage all these. I would love to just manage one big unit. Well, this time we could sell all those properties, right? All 3, 5, 15. And then we could take all the gains from those, because we're not paying taxes. And then we can move directly into the bigger asset, right? So what did we do? We took all those 15 assets, those 5, those 3. We've limited the amount of decentralized managing we had to do. And then we took all that buying power and we directed it towards buying one larger asset, right? Which that class of asset is generally going to give us more cash flow. It's generally going to allow us, again, to be in one space, see, touch, feel the real estate property. And then again, continue our growth there. Because I think we'd all agree, as you change classes and get the first one, it makes it easier to get the second, third, and fourth one, right? And then the second strategy, which is also very big, and you're starting to see it a little bit more, is moving from one big property down to a little. And this is happening more in Seattle, California, and New York, states that have properties with a ton of value. So you'll have one home in California for $1.1 million. And for you, you're like, well, that's like, it's basically a 2-bed, 1-bath condo, right? And you're just like, I'm in San Francisco. It's probably 1,200 square feet, if that. And it's just worth a lot. And you're like, well, I don't want to be in this state anymore, or I don't want to be in this location anymore, or I don't want my rental in this place. So what we do is you're like, hey, I want to sell this. But again, when we have that conversation, you don't want the money. And so you take that $1.2 million and you take it to California, Utah, Wyoming, Florida. Well, you can probably buy 3, 4 properties with that amount of money. So what we do is we go from one big property down to 4 little ones, right? And then that 4 little ones could increase the cash flow. It's probably going to decrease the cost of maintenance just by based on switching zip codes. And again, you're still controlling more real estate, right? And so we can really use this as a flexible rule that allows us to again control real estate how we want to, right? And again, this is another thing. Like if you said, how do I use a 1031? I'm going to say, like, listen, I'm going to a conference this year that I'm going to spend 2 active days just learning about this strategy. And so you can use it so many ways. So we're going to sit down and talk. But what I'm doing here isn't telling you this, hey, like do this system, it's going to work. I'm telling you to be proactive. Talk monthly, talk quarterly, talk weekly, because every single thing you do has an implication for your business, but it also has a tax implication. So anytime that I'm talking to someone about the tax implication, I'm finding that Pareto efficiency, right? I'm trying to maximize your utility with that operation with like the outcome you want, right? So like I'm maximizing the thing you want to do with how your tax liability is going to look, right? It's proactive. That's the whole talk on taxes. And this is what I'm really working to help shift the stigma on, because everybody thinks like, all right, I'll talk to my tax person in February. In February, I can't do anything for you. I can only help you be compliant with the year you just did. But if you come and talk to me, your tax professional, in June, July, August, there's so much time to start layering on even more strategies to make different moves and be like, hey, the end of year's here. What do you want to pay in taxes? And I may not get you to 0 like you want, but I probably can get you from 10 or 100 down to 80. And again, we're saving money. And again, we're being proactive and we're building, because again, that extra money you save is either usually going to go into retirement or it's going to go into growing your business, or you're just going to take it and spend it, which is what, if you that's what you want to do, you should do. So those are just, again, the layers of strategies. I just kind of took you through my thought process. I took you through how I talk to clients when we're kind of sitting down on the strategy sessions. And I'm trying to impart as much knowledge, but really that mentality of being as proactive as possible. I really want you coming out of this being like, hey, I need to call my tax person now so we can put a plan in for next year or for 2021 taxes now, today, right? So when the end of the year comes, you already know what you're going to pay. And you may, oh, that's not it. But you know, like, hey, I paid this much in taxes. I need to make this last payment of this much on the 15th. And you're going to go on it, right? You get out of that thought of, am I going to get a refund, right? Because it's not that it's bad, but it's reactive. So the last thing I'm going to touch on, again, because like I see it come up so much, and I'm starting to have more of these conversations, which is great, which is like, how do you structure, right? And there's really one nuance that I want to touch on super quickly, and it's really just to explain what it means, right? And that's operations versus passive, right? Because I don't keep hearing it, but I've heard enough when it stressed me out, is I own real estate properties. When do I go to an S corp, right? Because everyone's kind of throwing around S corp right now. So if your operations, how it's going to start is you're going to get a proof of concept as a sole proprietor, right? You work for yourself, no one in the business. This is you hustling, right? You know it works. So you're like, hey, okay, this works. I need to start separating myself from my business. So you layer on what's called an entity, right? The limited liability company, the LLC. Everyone knows this, right? And if you go to real estate, you're going to do the same thing. It's you as an investor. Hey, I want to separate my assets from me. I want an LLC. Like, okay, makes sense. We're in the same exact position. This is where it's different. The S corporation is only to help you mitigate self-employment taxes. Self-employment taxes is only felt on the operational side of things, not the passive income side of things, right? Because there is no self-employment tax. So what the big differentiator is, on the operation side, you go to S corp and we start directly mitigating that self-employment tax. And on passive, you're generally going to stop at LLC for tax purposes. And this is when you want to consult with your lawyer, because there's other entities will layer on. Does a C corp work? Does it make sense? That's the conversation we can have. But then you're going to do different kind of copes to kind of protect you against liens, things like that. You're going to hide yourself. And that's what you want to do on the passive side. So I just wanted to touch on that again. In your real estate, you'll never move to an S corp. In your passive real estate investments, right? Your rental investment properties. In your operational side, you should constantly be working to S corp, unless you want to take on a ton of investors and you're trying to do IPO or you're trying to raise money or things of that nature. So last thing I want to touch on is everything needs to flow down to your trust. Have that conversation and really set up what you want your empire to look like after we inevitably all go, right? We'd all love to live forever, but to my knowledge now, we haven't perfected it. So always plan. And again, I don't do that, but talk to your trust lawyer. And then again, if you guys want to reach me, these are the best ways to reach me. Email, LinkedIn, and that's my Facebook for my business, website in the works. But if you email me there, you'll get me within 24. So other than that, that kind of ends my presentation today. And if we have time, I'm willing to take questions.
Yeah, awesome. Thanks, Larry. For those who have questions, go ahead and submit them in the Q&A chat feature there. One question did come in, Larry. Let me just ask it here. It was in regards to cost segregation. For syndicators, most of the money we raise are from limited partners that aren't real estate professionals. Is it always worth spending the money for a cost seg study? It might make more sense for a larger asset like an apartment, but maybe perhaps doesn't make sense for smaller fix and flips. What are your thoughts there?
So, and again, like this is tough in taxes. You're always going to hear it depends. But for this one, I like the cost segregation study. And this is the reason why. What's happening is with certain classes of assets, like Airbnbs is the easiest one. They turn into a cash cap, right? An average single family home is going to lose money because of depreciation. Airbnbs are starting to trend to not only making money, but making tons of money. So if you have an Airbnb that's making you $50,000, $60,000 a year, which is possible if you have one or two, well, that negative depreciation cost from the syndication is going to directly cancel that out. So it's worth it to sit down with your LPs as they come on and kind of talk to them about what does their scope look like, because it's not a one size fits all. But those that depreciation loss, that paper loss that comes through from the K1 can do more than offset active income. If you have passive income, then it can offset that too. So it's worth the talk.
Yeah, for sure. And I fully agree, especially for the large apartment buildings like we've done, and you've been helpful with the cost segregation studies that I've completed and paid an engineering firm for that has been then passed on to apply to the tax filing and things. I think in this case the question remains, for the smaller ones, like if you're doing a fix and flip for a single family home, is it worth spending what amounts to a good bit of money comparatively for those smaller ones as it is for the larger ones? So I think that would be the follow-up question to consider there.
100%. And yeah, it's a deep conversation.
Yep. Oh, hold on, guys. Okay, I am still here. Next question is, what's more advantageous, claiming furniture, think about Airbnb, as operational expenses or as depreciable CapEx, or can you do both?
And so you can do both. You can't do both with the same piece of property, right? So the first thing to know is that if you buy something less than $2,500, it can be expense, right? The diminuses. So if you look up oh my gosh, it's Latin, I can't pronounce. But if you look up diminis, it basically says that for real estate, if it's less than $2,500, you're gonna expense it, right? If it's higher than $2,500, again, you can bonus depreciate it, as we talked about earlier. Whether you should or not, again, and this is why I love these conversations, these questions, is because we're proactive in thinking. The question I have to ask is, what do you want for your business, right? Do you want to pay more in taxes, right? Like, is it taking you from $40,000 down to $20,000, right? Like, what do you want to accomplish? Are you trying to qualify for more property? Are you fine where you are, right? As we layer on, like, what does your 3-year business plan look like? We can layer on the tax strategy to support that. What I will tell you is you can't treat the same piece of furniture, the same thing structure you buy in both ways. You can't have it expense the same year and then put it on a depreciation schedule, right? You're going to do one or the other. That's the important takeaway from this. But again, be proactive. And when you ask that question, always think, like, when you go into a consult, to help it be more narrowed and more beneficial, your business plan. So when they can be like, well, what do you want? You're like, hey, in next year, I want to close on 2 properties. The 3rd year, I'm done, right? And I'm just like, okay, cool. Then that means for me, we kind of want to see what you're qualifying for, right? Like how much property do you want to qualify for? So then I can help you get your AGI in the spot that you want. Because that's, again, that's what we're here for. This is absolutely a plan. So if you're like, hey, I want to make 120 this year, then I'm going to work as hard as I can to legally and ethically get you to 120. And I'm not going to try to get you more. I'm not going to try to get you less because that's what you tell me you want. And as we get proactive, we can do things. Because if we get to 125, you might be like, well, hey, like this couch, I kind of wanted to change all the couches. I'm like, perfect, let's do it. And then next thing you know, like I'm at 125. If we're not proactive, we're just talking.
Yeah, I know that's good. Let me see if anyone else has any other questions before we look to close out here. Any other questions from the audience? Okay. All right. I think you, well, first of all, Larry obviously covered a lot of ground. I think touched on a lot of important things that people can begin looking to apply. I think one of the most important things is really looking at what you're doing as a business. So even if someone's a novice and is just starting out in the game, really looking at it as a business, and then knowing that there are tax advantages that are afforded to business owners as well as to real estate investors and ultimately real estate professionals. And some of the things that you touched on today were key items towards that end. So let me land the plane and say simply thank you, Larry, again for all the knowledge you've imparted here for us. Thanks for providing your information. You've certainly been helpful for me in my business, and hope that others will reach out to you to seek support as well. And always a pleasure to connect on a Saturday morning with you here.
No, that's my favorite thing to do. Thanks for having me out. I could do this for hours. So thanks for giving me an hour to talk about things.
Absolutely. It was fun. And we'll go ahead and close out now. The members of the mastermind who are joining here, as always, we'll do our members only session immediately hereafter. So please switch over to that venue there, and I'll talk to everybody next time. God bless. Talk to you soon. Bye-bye.